The First Home Savings Account, or FHSA, is an amazing tool, but it has this hidden tripwire, especially if you're a couple that ends up separating. So today, we're going to break down exactly what happens to that account when a relationship ends, and, more importantly, how you can avoid a really costly mistake.
So, if you've got an FHSA and you're going through a separation, this is not some minor detail you can just figure out later. Nope, this is a huge question you need to ask right now. Because the rules are super specific, and one tiny misstep, well, it can lead to a massive, and I mean completely unnecessary tax bill. And I want to be super clear about this. Getting this wrong, it's not like you just filled out a form with a small typo. No, it's like tipping over the first domino in a chain reaction that ends with a big, ugly, unexpected tax bill, a bill you absolutely did not have to pay.
All right, so to understand how to do this right, we first have to look at the default government rule. And honestly, if you're not paying close attention, it's basically a built-in tax trap just waiting for you.
So here's the default setting. The second you move money from your FHSA over to your former partner, bam, the Canada Revenue Agency flags it. To them, you're not just splitting up your assets. In their eyes, you are making a personal withdrawal. And here's why that matters for your bank account. That withdrawal gets slapped right onto your annual income for the year. Let's say you're in a 30% tax bracket. A simple $10,000 transfer suddenly costs you an extra $3,000 in taxes. Ouch. Okay, but here's the good news. Thankfully, this whole tax trap is totally avoidable. There is a very specific government-approved way to do this that is completely tax-free. It's kind of like following a recipe, As long as you follow the steps exactly, it works out perfectly every single time.
And you know what's wild? The solution is actually pretty simple. There are just two conditions you have to meet. First, you need a written agreement or a court order. And second, this is the big one, the transfer has to be made directly from your FHSA to their account. That's it. You do those two things, and you completely sidestep the tax trap. And look at this. This quote is straight from the Government of Canada. This is the single most important rule you need to remember. I mean, burn this into your brain. It's a direct warning. You must not withdraw the property yourself. The money cannot, under any circumstances, pass through your hands or your personal bank account. It has to go straight from your FHSA to their registered account.
Okay, let's look at a real-world example. Meet Jordan and Kinsley. They follow the rules. They have their court order, and Jordan tells his bank, hey, transfer $3,000 directly to Kinsley's FHSA. And what happens? The result is perfect. Zero tax impact for Jordan, zero for Kinsley. And it doesn't even affect Kinsley's contribution room. It's just clean, simple, done. So, if the right way is that easy, why do so many people get it wrong? Well, it's what we call the cash withdrawal trap, and it almost always starts with the best of intentions.
This is the tripwire. The moment you pull that money out as cash, even if you're planning to turn around and hand it right over to your ex, it's too late. You've sprung the trap. That beautiful tax-free option, poof, it's gone.
Now let's look at Phil and Claire. They did part of it right. They have the written agreement. But Phil thinks, I'll just make it easy. I'll withdraw $4,000 and give her the cash. Big mistake. Because he did that entire $4,000 gets added to his taxable income for the year. Think about that. He's literally paying tax on money that he just gave away.
Okay, let's put these two scenarios side by side because the difference is just wow. Jordan does the direct transfer, and he walks away totally clean. Phil, on the other hand, takes the cash out himself. What does he get? A tax bill. And he creates a headache for Claire because now that money she got uses up her own contribution room. It's a mess for everyone.
All right, so just when you think you've got this all figured out, there's one more little detail you have to be aware of. Now, this only comes into play if you've ever over-contributed to your FHSA and have what's called an excess FHSA amount.
So what's that? Basically, it's any money in your account that's above your legal contribution limit. You're already getting dinged with a penalty tax on it. But here's the key thing for this situation. It totally changes the math on how much you can transfer tax-free. The rule itself is pretty simple, but you have to know it. You just take the total value of your FHSA and you subtract whatever that excess amount is. Let's look at Eric. His account has $18,500 in it, but he has a $10,000 excess amount. So you do the math and his maximum tax-free transfer amount is only $8,500.
And yep, you guessed it. Here's the problem. The court order says Eric has to transfer $9,250 to Ivy, but as we just saw, his tax-free limit is only $8,500.
So what happens to that extra $750? Well, that amount becomes taxable income for Eric. So even though he did the right thing with the direct transfer, he still gets a tax bill on that little bit extra, all because of that old overcontribution.
And check out the ripple effect. It's not just about Eric. That same $750 that's taxable for him, it's also treated as a new contribution for Ivy, so it reduces her participation room, which is basically her lifetime FHSA limit. So one little overage creates a tax problem for him and a contribution problem for her. It's a mess.
Okay, wow. So we've seen the right way to do this, the totally wrong way, and the kind of complicated way. Let's boil this all down. What's the simple, actionable plan to make sure you protect your money? It all comes down to this form, Form RC723. This is the magic piece of paper. It's the official instruction that you give to your bank that says, hey, move this money directly to my ex-partner's bank. It's what keeps everything inside that nice, tax-sheltered bubble.
So here's your action plan. Think of this as your non-negotiable checklist. Number 1, get it in writing, court order or separation agreement. Number 2, go direct. Insist on that institution-to-institution transfer. Number 3, use the form. Fill out that RC723. And number 4, and this is the big one, never ever take the cash out yourself. That's it. Follow those 4 rules.
Because if you do, you get the perfect outcome. Following these simple, but very rigid rules means the transfer doesn't mess with contribution room and has 0 immediate tax consequences. You're not just moving money, you're protecting your assets and making sure that at least this one piece of a tough process is clean and simple.
So, back to that question. Could a single form really be the difference between a clean break and a total tax nightmare? Well, when we're talking about your FHSA, the answer is a huge, resounding yes. So please make sure you use it.